The following pre-recorded program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
So 2020, what a year it's been. We're going to look back on this year and say we saw it in 2020 hindsight. But what a year it's been. We've got a lot to talk about today. One of the areas in which you get a glimpse into what's going on in the economy is by looking at freight. My guest today is in that area. You want to hear what he has to say? And we've got a lot to say. So let me just jump into it and get it going. And let me ask you a question. Suppose you got an email from a financial advisor who said, you should buy this stock. It's going to go up. And because it's just a cold email, you might jot down the name of the stock. You might look at it. You might just sit back, but you don't do anything. And the next month, you get another email from the same person who says, you should sell short this stock. You should sell it now and buy it back after it goes down. Again, you don't do anything. You just sit and wait. And the third month, you get another email and says, you should buy this stock. It's going to go up. And sure enough, at the end of the month, it goes up. And then at the end of that month, you get another email that says, you should buy this stock. It's going to go up. And sure enough, it does. And then you get an email that says the stock's going to go down, and it does. And that happens for 10 straight months. Every single time, that financial advisor got it right. And now, after he does it the 10th time, he calls you up and he says, I would like you to invest. You know what? You have a pretty good feeling this guy has been right 10 times, or this financial advisor's been right 10 times. He has not been wrong one time. So would you invest? A lot of people probably would invest, but what they didn't see is what was really happening. Because this advisor sent out in the beginning, that first month, he sent out 10,240 emails. And in 5,120, he said that stock was going to be up. And in 5,120, he said the stock was going to go down. And when the stock went up, those 5,120 that he had forecast the stock was going to go down, they never heard from him again. But of the 5,120 who had gotten the email that said the stock's going to go up, they all got a second email. Only this time, it was 2,560 that said the stock was going to go down, and 2,560 said that second stock was going to go up. And when that stock went down, those people who got the email that said that second stock was going to go up, they never heard from him again. But the 2,560 who had received two emails and had been right both times, they got another email. This time, 1,280 got an email that said the third stock was going to go up, and 1,280 said that same stock was going to go down. And of course, for the ones he was wrong on, those 1,280 never heard from him. But again, it was split into two, and this time 640 were emailed up, 640 emailed stock going down. And you get the idea. From 640, it went to 320. From 320, it went to 160. From those 160, it went to 80. From those 80, it went to 40. And from the 40 to 20. And finally, only 10 people received 10 straight correct predictions. Started with 10,240, but only 10 received 10 perfect predictions. But those 10 became excellent prospects. And those 10, most of those 10 probably would have invested a significant amount of money. It's an old thing called the Baltimore Stockbroker, and nobody really understands if it really happened or didn't happen, and nobody knows why it's called a Baltimore Stockbroker. But it's an old thing that shows when you're sitting on the outside, when you're the person that's receiving those emails, and every one of the 10 were correct, every one of the 10 are correct, you begin to feel that the person who's sending you the information is brilliant and right on. And it works. It works because that person did not tell you anything that was false. He was completely honest about his predictions, but he just didn't tell you the whole story. There was something true about the whole thing, and there was enough true that you draw incorrect conclusions. It's improbable, but those things do happen. And I live, and you live, in an industry where investors very often do not get the whole picture. I've just been, in the past couple of weeks, there have been a couple new releases about new ETFs, new mutual funds that have been out. But what's not mentioned in all of that is most mutual funds or most ETFs, they're not brand new to the market. They've been incubated for a year or more. They want to build a track record, and they build a track record to say, this is how this is done, before investors ever see it. It's like the Baltimore Stockbroker. If they don't have a good track record, you'll never see it. If you're one of the people who get the information, what you're seeing is something that worked, but you're never going to see the things that didn't work. But that's not all. When I started and when I licensed in 1986, I licensed with Payne Weber. I was a rookie broker. And when brokers left the firm, when they moved from one firm to another firm, what happened to their clientele? Their books were split up among existing brokers, and the biggest producing brokers got the best accounts, and the rookie brokers got the pretty bad accounts. Maybe only got one or two accounts, but I inherited one account that had a mutual fund. The person had invested $10,000 in a mutual fund, and the mutual fund was worth less than $9,000. But a few days after I inherited that account, a wholesaler came in, a wholesaler with information, and mutual fund wholesalers would make their rounds through the brokerage firms and through RIAs, and they talked to the brokers and say, you should buy this. They're selling their mutual funds. And this mutual fund came in to the Payne Weber office, and he talked about a mutual fund that had an excellent track record. It was producing over 20% per year for the previous 3 years. Now, the names of that mutual fund sounded really familiar. So shortly after, before the wholesaler was finished, I went out and I had to check to make sure that my client, this one I had inherited a couple days before, that my client really had the same mutual fund that this person was talking about, because this client had invested about 3 years before, and the account had gone from $10,000. It hadn't shown a 20% return. It had actually declined in value by over 10%. Not quite down 20%, but it had gone down over 10%. And I looked, and sure enough, this was the same mutual fund that the mutual fund company was marketing as having a track record of doing 20% a year for the last 3 years. So I came back and I asked the question. I said, I don't understand this. How is it possible you can be talking about a mutual fund that has increased 20% a year, and yet my clients lost money? And what happened? is that that client had inherited that mutual fund, but in fact, that mutual fund had picked up the track record of another smaller mutual fund. The mutual fund my client had was much larger, but it had a poor track record. And so what they'd done is taken a very small fund that had been incubated for a year and then came out and had a 3-year public track record, just 3 years, and they merged the two funds together. They got rid of the bad track record, gave the big fund the track record of the small fund, and began to market as a 20% per year return for the past 3 years. That's not uncommon. That happens a lot of the time. That's where mutual funds are. And there's something that happens in the mutual fund world that's worth understanding. And we're going to talk about that after we come back from commercial break. You want to hear, because it is something that impacts what's going on in mutual funds, in ETFs, and it can be happening if you have mutual funds in your portfolio. So don't go away. You want to hear what I have to say. You also want to hear what my guest has to say. So stick with me. We've got a lot to cover today. And if you miss any part of this program, you'll find it within a few days on YouTube. You can also find it on our website, Adams Financial Concepts. I'll be right back after this commercial break.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial Concepts. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I've been talking about what happens in mutual funds. And there's a golfer, Gary Palmer was a golfer who, I like the quote, he said, "The harder I practice, the luckier I get." But that's not true with mutual funds. There was a study done by Gary Porter and Jack Triffs, and they published it in the Financial Analyst Journal, and it goes back a few years, July and August of 2014. But they looked at the career paths of mutual fund managers and the role of merit. And what they looked at is mutual funds between the years 1996 and 2008, a period of 12 years. They looked at those mutual funds. They started with 2,846 mutual funds that were being managed by 1,825 managers, 1,825 managers. Of those managers, only 195 lasted 10 years. What happened is by the end of the first year, 19% of the managers had been dismissed. In the second year, another 19% went. So that meant that 38% of mutual fund managers were gone within 2 years. In the third year, another 17% were gone, which means over half the mutual fund managers were gone. They'd lost their jobs early in their career. They'd done poorly in returns of the mutual funds. In the fourth year, another 12%. So that meant that 2/3 of mutual fund managers were gone within 4 years. Only about 10% lasted as long as 10 years ago. 50 years ago, 10% of institutions owned the stocks in the New York Stock Exchange. Today, it's about 95%. So the managers are measured on their performance. They know if they beat the market or not. They know how well they do. And when you look at studies that are done over a period of time, like the Eugene Fama shared the Nobel Prize in 2013, shared it showing that mutual fund managers and money managers, only fewer than 7%, actually, when you count all the fees and expenses, only 7% do as well over the 10-year time period as their benchmark, and fewer than 3% do much better. And there have been studies. Janet's of Fund X talked about or they did a study, the FundX people did a study, and they looked at various hypotheses. They'd heard and read a lot about research. You've probably seen it too, that lower fees in mutual funds, the lowest mutual funds with the lowest fees are the best performers. That was something they looked at, but they took a different approach. They looked at mutual funds over a period of 25 years. They looked at 10,454 mutual funds and ETFs, but of that time, of those 10,454, only 269 survived during that time. Janus, for example, was merged into the Janus 20 was merged into the Janus 40. Janus International Equity was liquidated. Janus Fund was merged into Janus Research. Every year, funds merge or are liquidated, and you can never be sure of what the real managers do. But there are, over a period of time, 269 funds that survived during those 25 years. And there was no relationship for those 269 that survived, no relationship between the fees and the performance. Higher fees did not necessarily mean lower performance. Lower fees did not mean higher performance. The best performing funds, some had low fees, some had high fees. It wasn't the fees that were paid, it was the performance. And we go back to where I started. The managers who managed those funds were the few, the very few, the less than 10%, who survived during that period of time. In this case, it also seems to validate the information that Fama and French found in their study, for which Fama received the Nobel Prize, finding that fewer than 3% of money managers do better than their benchmark, whether it be the S&P 500 or the International Equity. Fewer than 3% do better than that. There's something that comes about from this because Jack Ablin wrote a book, Reading Minds and Markets. I quote him a few times. At the time that he wrote the book, he was the chief investment officer at Harris Trust. And while I think the book is only so-so, there was one comment that is really worthwhile. And it said, the most recent experience should not call into question why we invest in the market, but rather it should serve as a lesson that investing is not easy. Investment takes hard work, consistency, and objectivity. And that brings me to Scott McKillop. He wrote an article. I like what he said in the beginning. I like what he said through the whole article. And what he had to say was this. We would, and I'm quoting, he said, we would like to think that investing is a science, but alas, it's not. Water freezes at 32 degrees Fahrenheit. Light travels at 186,000 miles per second. When you throw a ball into the air, gravity always brings it back to Earth. We look for similar rules in investing. There are none. He went on to quote some of the most recent Standard & Poor's SPIVA study, of 2018, which compares managers to a benchmark, and the same results as we talked about before. Same kind of thing. There are no rules investing. There's no science to investing. It is an art. It's not a science. Skill exists, as Malcolm says, but it's far from impossible, and it's very, very challenging. And it's not unlike a pattern that's seen in every complex area of human endeavor, whether it's in law, whether it's in medicine, whether it's in sports, or music, or acting. In any of those examples, you find that the exceptional people do not win every case, do not save every life, they do not win an MVP award every year, they don't win a Grammy every year, they don't win an Oscar every year. They have slumps, they have losing streaks, and times when their ideas fall flat. But the fact is, over time, they stands out. The fact is, water doesn't care what we do. It still freezes at 32 degrees. Light and gravity don't care either. Markets, on the other hand, are human creations that reflect the best and worst of our nature and evolve over time, just like we do. That's something when you're doing investments, when you're talking to financial advisors, that's something to be very, very aware of. The fact is, my clients don't want to run out of money. My clients want to be able to cover the cost of catastrophic illness, whether it be COVID or whether it be something else. They don't want to see inflation eat away their principal, and they want to pay as little as possible in taxes. That's what my clients want to see. That's what I want to do. You can find my performance and what I've done for my clients and how I've helped them get through this time, how I've gotten them so they don't run out of money, so that they have the funds if they have a catastrophic event. You'll find that performance on the website, adamsfinancialconcepts.com, and it's been an exceptional year. I have to say, it's not normal when you have. I can only think of 2 other years in my 34 career when I've seen this kind of a return of being up. And we're up almost 50% for the year in the growth accounts, and we've more than doubled the accounts in the profit sharing accounts. That's unusual. It's not normal, but it happens. It happens sometimes that you hit a hot streak. Hitters hit it, and in this case, it is there. But that doesn't mean a reversion to the mean. It means it probably won't do quite as well next year, but who knows? It could be. So during the past 15 years, I've done almost 3% better. It's been a very positive time. But I want to shift gears. I do want to introduce my guest before we come to commercial break. My guest is Wayne Levinson, the CEO and founder of Bulk Freight. Welcome to the program, Wayne.
Thank you.
So, Wayne, give us just a quick introduction about bulk freight. We're going to come back. We're going to talk to you about your background and get more into bulk freight when we're back. The commercial break is in 1 minute, so we've got a little bit of time.
Absolutely. So bulk freight is a 3PL specializing in the transportation of bulk liquids over the road within the domestic and North American markets. We have a variety of customers in all different places within the verticals of oil and petrochem, as well as specialty chemicals.
So now you've got a preview. You know what's coming. We're going to be talking after the commercial break about bulk freight. We're going to be talking about what bulk freight does. We're going to talk about why that's important to understand and what's going on in the economy. So do join me. We'll be back after this commercial break. And once again, if you miss any part of this program, you can find it on our website. You can find a podcast there. You can find it on YouTube within a few days. You can sign up for our newsletter. You can email me at mike@adamsfinancialconcepts, and I will send you our newsletter. It's going out weekly now. And you can find all sorts of information on the website. Stay with me. We've got the commercial break, and then we'll be back.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial. About Money with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com.
So I'm here with Wayne Levinson of Bulk Freight. Let's walk back and let's talk about your background. Tell us about your background, Wayne.
Yeah, absolutely. Thanks for having me on today, Mike. So my background is I actually grew up in a small town on Long Island in New York, and was fortunate enough to be one of the 21 students from my 300 graduating class to end up going to Indiana University. There I was going hard for accounting and finance, and of course, while I was in college was when we had our big financial crisis and left me with few jobs in that area. And so I saw this interesting major that I could switch to called logistics, and moved forward, graduated in 2011 from Indiana University, and then moved on to my first job at one of the largest trucking companies in the chemical trucking side in the U.S., based up in Green Bay, Wisconsin. Go Pack Go. From there, I got to grow the company and eventually moved out to Tahoe, where I was able to pursue my passion of daily skiing at the end of my workday and still working those early East Coast hours. And then with time, our business grew too much to really be able to maintain a solid workforce in the ski town of South Lake Tahoe. So our entire team moved up to Seattle, where we've been for the past 10 years.
So let's talk about bulk freight, what you do. You're a specialty.
Yeah, so we specialize in transportation of bulk liquids, and we refer to bulk as being anything in the plus 5,000 gallon range over the road via trucks. So across the U.S., Canada, and Mexico as well.
So a lot of your supply comes in, I assume, through ships at one of the ports. What happens to it then?
Yeah, so a big portion of the petrochemicals used in the United States, they do come into the United States at the ports, and that's kind of really where the beginning of the supply chain is. For the more commodity type products, the oils, the petroleum products, those are typically either transloaded into a barge or directly onto rail and distributed via barge, especially for the larger liquids. Barges are kind of just like those big boats that you see every day docked outside of Seattle, except for they're not as deep and they're able to go on the inland rivers. At which point they continue on to distribution points, and that's kind of where the story of our business takes off. Because we focus on the trucking side of the business, we're really that last mile provider. So our customers, majority of them are chemical producers, will have us come to a variety of their distribution points, pick up products, and deliver them to the final user.
So tell us about some of the products.
Yeah, so because we focus on the specialty chemicals, typically our products are more focused around small blended materials. So not necessarily coming off of that production line, or the way I was always taught to think about commodities is that they flow through pipes very quickly. So oil is kind of the easiest one to imagine like that. But ours are kind of more refined. So oftentimes they're byproducts or co-products of the oil refining process, but they could be from a variety of other processes as well. And really what makes specialty chemicals special is oftentimes they may have one or more hazardous properties that make them somewhat more difficult to deal with. And so our company really focuses on being masters of these specialized chemicals and the need to transport them, making sure that, for instance, the chemicals that we're moving don't react with the bulk container, so our trailers that we're putting them in, or each other. Sometimes there's a little bit of residual that could potentially create a big problem for the next product. So making sure that we understand the full process and the chemistry behind it, and really first and foremost to provide a safe environment for our truckers and for our customers as well.
When you think about some of the petroleum products, if you pick up a tube of toothpaste, for example, there's there's maybe 4 or 5 different petroleum products in a tube of toothpaste. It's not just all about motor oil or jet fuel or whatever. It's a lot of specialty products, and somebody has to haul those and furnish those to the chemical plants where they're combined. And you're that guy.
It's actually really interesting because the first most important thing to the majority of our clients is safety, and safety is in our blood. It's the heart of everything that we do, and really that's what makes our company special is being able to manage those very specialized products. You know, the parts, the small parts that go into your toothpaste to keep it fresh. A lot of preservatives are PAO based or olefin based, and so you know our company kind of works very high up in that supply chain in the production of goods that are served for mostly American households.
And so the people that are actually hauling the chemicals, they're contracted with you, right?
Correct. So we have about 240 contracts with specialized chemical hauling carriers. But on an average year, we probably utilize about 100 to 150 different carriers.
And what is the vetting process like? I would imagine it's pretty significant to maintain a safety record.
Yes, so we're very proud of our safety record. In 12 years in business, we've had 0 safety incidences that affected any other individuals other than the driver driving down the road. And it's extremely important for our clients. You know, we deal with very, very large chemical producers from not just the United States. I mean, these are large multinational companies, and for any one of them to have their name on the front of the newspaper with some sort of accident, is not necessarily what they want to wake up to. So our vetting process is very in depth. First and foremost, we look extremely deep into the driving history of that company with the Federal Motor Carrier Safety Administration, and then we go further into insurance requirements that go above and beyond significantly what those are of federal requirements. So, for instance, our carriers are required to maintain a minimum of $5 million general liability, which in federal standards is $750,000. So our carriers are typically, and as far as we've seen, we make sure that we're always vetting to take the worst egg out of the bunch, but we believe that we have the best carriers in the business for transporting chemicals.
And your track record proves it, right? You haven't had a single accident, correct?
Absolutely, not a single accident.
That's incredible. So let's talk just a little bit about the economy, because you get to see things months before it shows up in all the data. So tell us about 2020 and what you saw in the beginning of the year, what you've seen in the middle of the year, and what you're seeing right now.
Absolutely. Well, as everyone knows, 2020 has been a wild ride so far. The year started off strong. We came out of one of our best years ever last year, and the year started off strong. Of course, there was a very quick dip right when the shutdown happened, and we noticed about a 5 to 10% fall off in expected revenues. Another component of our pricing is petroleum. And of course, we all know what happened to petroleum earlier this year in the late spring. WTI crude went negative, and so with the compressed margins from lower fuel costs, we had a not great second quarter. What I can say is that over the past 3 months, we're year over year over where we were, and we're doing great, which is also typically a pretty good sign for what's coming up in the future of the economy. I wouldn't say that it's something at this point that I'm, overly abundantly excited about, but the fact that we were able to recover so quickly from that quick dive off, beginning in March, was definitely inspiring.
And it looks pretty good for the last few months, right?
Absolutely. The last 3 months are trending in a direction to make up for that dip that we did have. So typically what that means is because we're so high up in the supply chain, if you think about things when they're liquids, they're pretty up in the beginning processes of being formed into widgets. Typically we see that the effect to the numbers on financials are about 3 to 6 months behind what we see. So that strong tick up looks like it's going to be coming up any day now, and it should be sustained for quite some time.
That's great. Thanks for being on the program, Wayne, and it's been very informative, and it's very optimistic. I think we're seeing a pickup, and you've confirmed that. It looks like this coming year could be a pretty good year. So thanks for being on the program.
Yep.
So when we come back, we are going to talk about the economy, so don't go away. We're going to start with Jerome Powell and what his comments were. I'll be right back after the commercial break.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial Concepts. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So did you see where Jerome Powell, the head of the Council of Economic Advisors, Jerome Powell commented on the economy? He said the economy as we know it has changed, and it's changed forever. What we're recovering to as we come out of the coronavirus time, what we're recovering to is going to be a very different economy. They're seeing trends. We're seeing trends in technology and telework and automation and big and lasting effects on people, how people live and how people work. You know what? He is right, and what he's saying is not a new phenomena. It's been going on for a long time, these periods of time when things change. And I talk very often about the three key factors: technology, demographics, and lifestyles. You can go back to the 1870s, and it's been a while since I've talked about the 1870s, but in the 1870s, 50% of the people lived or worked on a farm, 50% of the population. Taking it back, 23 million, going back to 1850, 23 million people in the U.S., 11 million were farmers, 64%. Agricultural exports, 189 million were 81%. Agriculture exports, 81% of the total exports we were sending. Cotton alone was 124 million. Cotton represented 54% of over half of our exports. By 1900, we'd grown to 76 million people, but we had only 29 million on the farms, 38%. Agricultural exports had grown almost sixfold, but had dropped as a total percentage of exports to a little over half. And farming was not just food, it was cotton. And even as a percentage of our exports, cotton had dropped as a percentage of our exports. By 2014, we had 318 million people in the country. Now we have over 330. And we have fewer than 1 million farmers. Less than 10% of what we had in 1850, 165 years before. We actually had 994,270 farmers in 2014. Our exports had grown almost 1,000-fold to $150 billion, 1,000-fold from 1850. And that was a significant increase. If you look at the productivity per person working on the farms, look at that. It had grown 10,000-fold. That was the productivity. 1850, the main source of power was the horse. It was a single person. It was harvesting with a person. By 2020, you're using tractors and combines and automation and milking parlors, and plants and animal production, increasing productivity enormously, 10,000-fold. But it wasn't just in farming. Think about manufacturing. In 1940, 35% of the U.S. population was working in manufacturing. Today, it's less than 10%. The output from 1940 to today, the output per person has grown 20-fold. The same person today is producing 20 times what one person produced in 1940. I mean, we've seen factories shutting down. We're seeing that happening quite a bit of time. But we're seeing changes take place. You know, one of the examples I'd like to look at is General Motors. Not picking on General Motors, but in the 1950s, General Motors had 50% of the car market in the world. 50% of the world car market. Think about it. 1 out of every 2 cars that were sold were manufactured by General Motors. Chevrolet itself was the second largest GDP in the world. The only GDP that was bigger was that of the United States. That's how big Chevrolet was. There were fears in the 1950s that General Motors was going to be broken up into parts because they had such a dominant role in the economy. Back in those days, there were 3 car companies, General Motors, Ford, and Chrysler. Today, if you look at what's going on, there's 10 car companies in the U.S. that each one has 3% or more of the market. General Motors no longer dominates. Chevrolet no longer dominates. There are a lot of car companies here. And if you look at the total number of car companies, it's well over 25. So, yes, today we're going through the change. We're seeing changes in technology and demographics and lifestyles. Those are the big 3, and those are the things which carry us through the investing, and understanding that and understanding where to be is crucial for making money in the stock market. If you look, you know, and you compare how certain money managers are doing compared to the index funds, you know, when you look at my track record compared to the index fund, and I'm not the only one that's doing exceptionally well this year, even though we're actually, as of this week, we're over 50% above last year. The Standard & Poor's is just barely into the double digits, a fifth of what's happening with my clients. But that's, if you look at it, that's the index. And of that index, the Standard & Poor's index, there's 500 stocks, but the FANG stocks, if you look at just the FANG stocks, they dominate the 500 stocks. They account for 15% of the market capitalization of the Standard & Poor's. The FANG stocks up 46%. Standard & Poor's, if you look at it total, 11.1%, and that's as of last week. And the Standard & Poor's without the FANG stocks is only up 2.8%, which means there's a lot of companies in the Standard & Poor's which aren't doing so well. And by the way, at Adams Financial Concepts, we may be up 50%, but we do not own a single FANG stock. They don't meet our criteria. So it's not that we're investing in the FANG stocks. I have some deep reservations about that. But when you look at this concept of investing passively and putting your money into an index fund, what you're looking at is investing in stocks that are doing well and a lot of stocks that aren't doing well. And if anything shows up, it's this year when you're seeing a few of us who are having exceptional track records compared to the index. We're blowing the index away. You know, and yes, some of the stocks that Adams Financial Concepts owned and bought were prior to the time they became part of the Standard & Poor's. It's understanding the changes in technology and demographics and lifestyles and being ahead of the curve instead of behind the curve. It's understanding where things are going, not where things have been. It's owning those things which have potential to continue to increase, which have lower downside risk. I talked about risk and reward a couple weeks ago when I talked about Eastman Kodak compared to Microsoft. You know, you can see the differences that way. Anyway, the economy is changing. The way to make money is to be in front, to know what the technology, demographics, and lifestyles are doing. That's where you need to be if you want to make money in the stock market. That's my opinion. That's worked for us. It's worked for us for 15 years. It's continuing to work this year. And I believe it's going to continue next year and the year after and the year after and the year after that. It's my opinion. I could be wrong, but I believe I'm going to be right. That wraps us up for today. If it's Saturday, we're going to be talking about money. I wish you a very happy Thanksgiving and a very good coming year in 2021.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams here on AM 1590. The Answer. The preceding program was sponsored by Adams